What is going on, YouTube? I'm Mike with Penner Investments, and today I'm going to talk about trading snowflake put credit spreads. Be sure to hit the like button, share this video so others may learn, and subscribe to my channel so you do not miss out on future content. Let's dive in. Snowflake just reported earnings last week, but they also announced that the CEO was stepping down and the new CEO was going to be taking over. And this, with cutting back future guidance, has caused the stock to sell off just over 20%. I really like this company and believe that long-term this will be a good play, also a good investment. I think the sell-off is a little overreactive and do not think the stock will go down much further from here. Looking at the 3-month chart, you can see that the price action is just outside of the Bollinger Bands and the stock is starting to become oversold. What I'm doing to take advantage of this is selling a few naked puts, and I've also entered a couple of trades on put credit spreads. Last week I entered 20 contracts on the 165 and 160 strikes for a put credit spread. This gave me a credit of $1,132. The stock would have to pull back another 7% to put this trade at risk. On Monday, I entered another 20 contracts at the 155 and 150 strikes for another put credit spread trade, and this gave me a credit of $1,452. Even better premiums, and I'm still being a little bit further away from the money, which is keeping the trade a little safer. My 155 strike on this trade is over 12% away from the money, giving me a little more protection from the trade being at risk. My thoughts on these trades is the stock will recover from this overselling that has occurred as a knee-jerk reaction from the company changing up CEOs. As long as the stock doesn't drop below my higher strikes on these put credit spreads, both trades will be wins. Also go out to the closest expiration to 45 days out, and I select my strike price by looking at the closest strike to a 15% delta. This means my higher strike only has a 15% chance of expiring in the money, meaning that my trade has an 85% chance of being a 100% win, meaning that I keep all the premium without closing the trade early. I only close the trade early if the trade was put on and earnings happens to be during my 45 days and it's kind of closer to the end of the expiration cycle. If it's right at the beginning, I just wait until after earnings to enter the trade. But if it has earnings towards the end of the cycle and the price is starting to get close to my strike price, I simply close it early to not hold it over earnings. But if I'm starting to get way away from the money, then I just let it ride. Other than that, I only like to close the trade if the stock price drops below my higher strike price. Then I just go in and close it immediately. And this way I'm minimizing any losses and never taking a max loss on a trade. My plan is to hold this trade to expiration and keep all the premium collected. As always, if there's ever anything you'd like me to discuss further, drop a comment in the box below. Thanks for watching and good luck trading.